Welcome to my February stocks and shares portfolio update. If you're new to the channel, I have a plan to build a 100k portfolio in my InvestEngine stocks and shares ISA account over the next 3 years. And I'm using this channel to share my journey with monthly portfolio updates. So if you want to follow the journey and hopefully get some insight and entertainment along the way, then I'd greatly appreciate a subscribe. But for this video, let's get into it. And this month, I've really shaken things up with my portfolio by selling 2 ETFs. However, before we come on to that, let's start off as usual by taking a quick peek at what's been happening in the UK and US markets, as this will provide a reference point for my own portfolio's performance. And let's start off by taking a look at what's been happening in the UK. Here, the big news recently has been that we've entered a technical recession after consecutive drops in GDP over the last 2 quarters. A key factor in causing this is that people are spending less, leading to less demand, which is not too surprising given we remain in a cost of living crisis and people's purses are being squeezed to the brim. However, it's not all bad news, as relatively speaking, this is a mild recession. In fact, it's the mildest since the 1970s, as the last 5 recessions in the UK have all seen the economy shrink by more than 1% in the first 2 quarters, whereas in this case, the total shrinkage is around 0.4% in the 2 quarters we've just gone through. The other good news is that the inflation data in the UK was better than expected, as the CPI inflation rate was at 4% at the time of recording, compared to the expected figure of 4.2% from most economists. Although some of you may not see this as good news and rightfully point out that it's been a big cost to bring inflation down in the UK, now that we're in a recession and remain in a cost of living crisis. Nevertheless, this is not a political channel, it's a personal finance channel with a pinch of economics. So let's move on to what these key economic movements all mean for the UK stock market. And let's take a look at how the FTSE 100 has performed over the last month. We can see that it's been a very good month for the FTSE 100 as it's grown by 3.39%. Very interestingly, the Friday before I recorded this, the FTSE went up by 1.5% in one day. This was just after it was announced that we're in a technical recession. And on paper, in normal circumstances, being in a recession wouldn't be good for the stock market. But in this case, the market is perceiving it as a good thing, as they expect this to force the Bank of England's hand to deliver interest rate cuts earlier than expected in order to revive the economy. According to the Financial Times, the market is now pricing in a 65% probability that the first rate cut will happen in June, and they're expecting 3 0.25% rate cuts across this year. These rate cuts would of course be good news for us as investors, as lower interest rates have a positive impact on the economy and the stock market. So overall in the UK, it's been a very positive month for the stock market. If we move over to the US, a potentially more important market for most of you watching this, given that anyone who's invested in global stock market funds are heavily exposed to US companies. Here, inflation also fell. It fell to 3.1% from 3.4% the previous month. And on paper, this sounds good as inflation is falling. However, it wasn't taken as particularly good news, since most economists and wider analysts expected inflation to fall more to the 2.9% mark. But to me, I still perceive this as good news, as the bigger picture is that overall inflation has fallen massively from the peak above 10% in 2022. And if we dig deeper into the recent inflation data, there's a clear reason why inflation has not fallen further recently, and that reason is shelter. Shelter had the biggest impact on the most recent inflation data, as it contributed over 2/3 of the monthly all item increase. And unlike other inflation categories, shelter inflation reflects a delayed effect. The reason for this is because it mainly represents higher rental costs as a result of owners of rental property passing on the effects of interest rate hikes to their tenants. And this effect takes time. So hopefully once shelter inflation eases, overall CPI inflation can break free of the sticky 3% mark in upcoming months and get closer to the Federal Reserve's 2% target rate of inflation. More generally, the US economy has been very strong, as unlike the UK, it grew in the final quarter last year. And it didn't just grow, but it smashed expectations, growing at 3.3% compared to the 2% growth rate expected. So overall, the economic indicators in the US have largely been positive over the last month. And now we know this, let's check what this all means for the US stock market by taking a look at the performance of the S&P 500 over the last month. And we can see it's been a great month for the S&P, as it's grown by 4.7%. We can see on this graph there was a slight dip when the inflation figures were announced around the 12th and the 13th of February, but since then it's recovered and it's been extremely strong towards mid to the end of February. And there's been some real standout companies in the American stock market over the last month, so let's give these a mention. And the first one is ARM, the UK chip maker, which is listed on the American stock market. And this company went up by over 72% in the last month after reporting higher than expected revenue. Similarly, the stock price of the data specialist company Palantir went up by 52% over the last month after it also reported better than expected revenue figures. So these two companies did extremely well over the last month. However, the most interesting rise has to be Lyft, as their stock price went up by over 65% in under one day. Unfortunately, this was because of a typo, because of an extra zero in their earnings release, which made their numbers seem a lot better than the reality. But even after the pullback, they're still up by over 40% in this month. So overall, it's been a really good month for the UK and the US stock markets. And there's been some standout companies in particular in the US with some spectacular growth. Now we know this, we can take a look at my own portfolio's performance and bring up InvestEngine's app. We can see that my portfolio over the last month is up by 5.74% in percentage terms and £849 in pound terms. And I'm now sitting at a balance of £16,769. So overall, I'm pleased with the growth I've got in this portfolio over the last month. The growth is better than the FTSE 100 and the S&P 500. And this rarely happens. I don't always beat the benchmark, so it's nice to see this month. I've also had some dividends this month, so if we switch tabs, we can see that I've had £28.79 in dividends. And this is from my HSBC MSCI All World Fund. These dividends got reinvested straight into my portfolio, so I don't take them out of the portfolio, I just keep investing any dividends I receive. So February saw steady and continuous growth in this portfolio. And if we take a look at how the overall portfolio has performed since I opened this account, we can see that I'm up by 11.56% in percentage terms. And this doesn't consider the dividends I've received. If we consider these, it likely adds another percentage point to this figure. So in reality, I'm probably up around 12.5%, which I think is good growth. And if we look at this graph and look specifically at the green line there representing the portfolio value, we can see that over the last few months, there's been real good growth in the market and in this portfolio, as the gap between my portfolio value and my contributions has been increasing. So hopefully this positive trend continues in the coming months. And let's now turn our attention back to the portfolio performance this month in February. And before we dive into the individual ETF performance, I want to discuss the portfolio changes I've made this month, as I removed two ETFs. I've sold two ETFs this month. The first ETF I've sold is the iShares Physical Silver ETF. Previously, it had a small allocation to this ETF, around 3 to 4%, and I sold it because I wanted to streamline my precious metal allocation. I only want going forward one precious metal fund in my portfolio, and that's the Physical Gold Fund. And I want to restrict the amount of my portfolio exposed to precious metals to 5%. So I decided to sell the Physical Silver Fund and I've reinvested it in my global fund. The second fund I sold was WisdomTree's Battery Solutions. This fund sparked a lot more internal debate on whether I should sell or not, but I eventually came to the conclusion that I should sell, as I feel like this fund is too risky for my risk appetite now. I feel like when I bought into the ETF that the fund and the sector was less risky, the growth potential was less risky, but I feel like the odds are no longer moving in my favour in terms of the dependencies which need to fall into place to make the growth happen. For example, governments aren't forcing their nations to adopt electric vehicles like I expected and as early as I expected. And this is a key factor which will spur growth in this sector and this fund. So for these reasons, I decided to sell the fund, and like with the Physical Silver ETF, I kept the money in my portfolio, I just moved it into my global fund, the HSBC MSCI World. And on that note, let's deep dive into how my individual ETFs have been performing over the last month. And let's start off with that HSBC MSCI World Fund. We can see this fund was up by 6% over the last month. This growth isn't too surprising, given that most of this fund is exposed to the American stock market, and as we went through earlier, America had a real good month. There was lots of good positive economic news, and the S&P was up by a good amount as well. The next fund is the iShares MSCI World Small Cap. This also had a good month. It was up by 5.57%, and the iShares MSCI Emerging Markets was up too. This fund was up by 7.2%, and it's nice to see this particular fund is up, as it's been very rare that this fund has been up since I started investing in it. So hopefully the tide is starting to turn. Hopefully we start to see good growth in the Emerging Markets Fund this year and in the coming years, as since I started investing in it, like I said, there hasn't been too many moments like this. The next fund in my passion sector, WisdomTree's Cloud Computing, also had a very good month. This was my best performing fund, and it was up by 9.3%. And the final fund, the iShares Physical Gold, which is the only precious metal fund remaining in my portfolio, this also was up, but very marginally. It was up by 0.45% in percentage terms. So overall, it's been a good month for the stock market and a good month for my portfolio, as I've had growth in all my individual ETFs over the last month. And this really happens month on month. So hopefully it continues for the rest of the year as I try and reach £100,000 in portfolio value across the next 3 years. And if you'd like to find out more how I plan to achieve this, I should have a video around here. But for this video, thanks for watching.